Hi traders, Dr. Barry Burns here with Top Dog Trading. Okay, today I'm going to be answering a question that's come in through my blog, and in fact it's come in quite often, so that's why I answered it in my blog yesterday and posting it here on YouTube today in video format. And the question is, what's the best interval for day trading? And most people, when they ask that question, they're assuming 1 minute chart, 2 minute chart, 3 minute chart, 5 minute chart. What's the best interval? My answer is no minutes. Okay, I don't like minute charts too much. They do have some advantages, but to me, the disadvantages outweigh the advantages. I like what are called tick charts as opposed to minute charts. So let me explain what that is. And if you want to get a little more detail, you can go to my blog, topdogtrading.com. That is my blog. The very first page is my blog. And I posted a more detailed explanation on there. But here I've got the video, so it's kind of nice to see the video explanation as well. Okay, so here's a 2-minute chart of the S&P E-mini. And the moving average here is just a 20 simple moving average. I just put it there as a reference point. Let's say that we wanted to go long off of this little mini double bottom here, and with my trading method what I do is I never risk more than about a bar, sometimes a bar and a half. That's about it. Very, very low risk. So in this situation what I'd be doing was I would be measuring the range of this bar here. Okay, we'll circle it. And I would enter just one tick. A tick in this case is the minimum movement of the S&P, which is 1/4 of a point, and my stop would go one tick below the low. So the range of this bar, the high is 15.1850, the low is 15.16 even, so that's a 2.5 risk, 2.5 points, 2.5 points, but there's 4 ticks in every point, so that's a 12 tick risk. A tick is again the minimum amount that the market moves, the increment in which it moves in, $12.50 per tick. So that's $150 per contract. Okay, so again, this is 3 points, and the risk is $150 per contract. And that's one of the problems with minute charts. At turning points, it tends to create wide range bars like this. And when you have wide range bars at turning points, and I'm looking to buy cycle lows and sell cycle highs, so I'm looking for these turning points. And minute charts tend to put in these wide range bars, and that increases my risk. And risk is the one thing you can and must control in trading. So I'm always looking for ways to reduce my risk, and tick charts is one of the ways that I do that. Okay, so remember this, or jot it down on a piece of paper. I'll remind you about it in a minute. We're going to pull up a tick chart of this exact same place in the market here in just a moment. But before we do that, the other thing I want to show you is also that this is a 2-minute E-mini chart. So each bar represents 2 minutes of time. When 2 minutes and 1 second starts, then the next bar starts. And this little double bottom, notice how many bars are here. 4 bars. And that's it. And that's because the market doesn't care or I should say the chart doesn't care what's happening here, other than it's just going to make the price bar hold this vertical line for 2 minutes, regardless of price movement, regardless of volume, regardless of anything. And at turning points in the market, volume does tend to come in. You want it to come in. If this market's going to go up, there should be some buying volume down here, right? If there's not, then it's less likely the market will continue. Well, if there's going to be buying volume, that's going to normally make the market go up. And if the market's going to go up because there's a lot of volume coming in, that's going to make the price go up. But if you don't allow a new bar to form, then that means this bar is going to be a wide range bar. Okay? But notice the symmetry. Other than that, also notice just the symmetry. There's only 4 bars here. You know, is that really a double bottom? Well, yeah, sorta, kinda. But what I like about tick charts is they form more of a symmetrical price pattern. Okay, so having said that, and just kind of keeping this in mind, by the way, at my blog I've got two charts side by side, so it's easier to look at them side by side, but with a small window here I can't really do that and make it too visible. On my blog I show the NQ, here I'm showing the ES just to satisfy different people. So let's pull up the tick chart now and see how different that looks. Okay, so here's a tick chart. Again, this is the E-mini futures, and this is a 200 tick chart. So what that means is each one of these bars represents 200 ticks. Now, what is a tick? A tick is a trade. So you can't really compare tick charts and minute charts very well because it's not apples to apples, it's apples to oranges. In other words, some of these bars might be 2-minute bars, but another one could be a 5-minute, another one could be a 30-second bar, another one might be a 10-minute bar. So it's not bounded by time. Each bar is defined by how many trades go through. A tick is a trade. So in this way, tick charts incorporate volume right into the price pattern. Now, having said that, it's not strictly volume. Again, a tick is a trade, so one trade might be for one contract, and then the very next trade could be for 50 contracts, but that still only counts as 2 ticks out of the 200. So just be very aware of that. So it is incorporating volume, but not in a linear fashion. Okay, now let's look at this exact same spot we just looked at, except now instead of a 2-minute chart, we're looking at a 200 tick chart. First of all, here's what I'm talking about with a more symmetrical pattern. Look how different this double bottom looks now. It looks more like a real, just nice symmetrical kind of a. The other one is a double bottom too, but this has more of a sine wave pattern to it. In other words, when you get a lot of volume coming through the market, it forms more bars, and so it just kind of creates a more, like I say, sine wave type flowing formation to it. And I like that. The other thing is when not very much volume is going through the market at all, a minute chart will form a lot of little doji bars and just look like a mess. And you get a lot of bars, but the market's not going anywhere. You get choppy markets. On tick charts, when not much trading is happening, then it just doesn't form very many bars, and so you don't get as much choppiness in the price pattern, and that's a huge advantage as well. And then finally, you also want to look at your entries. So here's our entry bar for that long trade we were looking at. Now here, the range of this bar is different. Remember the last one, the range of it was 2.5 points, and so we enter 1 tick above the high of that bar, put our stop 1 tick below the low of that bar. And in this case, the term tick is used a little differently. When I talk about getting in 1 tick above or 1 tick below of the bar, I'm talking about 1 increment of movement, which is 1/4 of point on the S&P. Okay, now this bar, the high is 15.1775, the low is 15.16 even, and so the range of the bar is 1.75 instead of 2.5. So your risk is 2.25 points instead of 3 points, and that's 25% less risk. So 25% less risk. If you can do that on most of your trades, that's huge. That is huge. You can reduce your risk by 25% and still maintain accuracy. Wow. I mean, that alone right there can revolutionize your trading. So this is why I use tick charts instead of minute charts. And again, if you want more about intervals and and a little more details, as well as being able to see both of these charts I just showed you. Look at them side by side. Go to my blog, topdogtrading.com. The very first page is my blog. And the most recent entry there as of July 13th, 2007. That is the entry for this particular topic. Okay, thanks everyone.